Okay, I just wanted to point out one of the issues when it comes to doing these multiple year consolidation statements. There may be some other nuances, but the biggest one is with the textbooks approach, and it's the approach that we all have to take, whether we do it the textbook way or not, but it's under the A entry under the textbook approach, which is for the assets. This is the entry that, if you look back at the acquisition date method, the A entry brought the assets into the consolidation statement at their adjusting for the fair values between the book value and the fair value of the subsidiaries. That's what the A entry did. The A entry sort of came in between and took care of that adjustment up or down. It can be a plus or a minus, don't forget. At the end of the first year, we do the same thing as the acquisition date method. We bring the same numbers over when we do the first balance sheet, and then we start to depreciate or amortize up or down, as the case may be, with those particular assets or liabilities. Don't forget, liabilities can come into the picture as well as being different between the book value and the fair value. So again, what happens when acquisition date and at the end of the first year is we bring over, or we adjust when we go from this book value amount here in the subsidiary, the subsidiary columns, we then do the adjustment, the A adjustment, which takes into account differences in fair value. So when you get over here, the assets and liabilities are listed at the fair value when you're adding in the consolidated subsidiaries amounts. The book value is all that comes over from the parent, of course. That's way over here. The parent they just bring their numbers over, but we do this adjustment. This is a mess of a sheet already, but I think you get the picture, and you can certainly look in your textbook for a review of the A entry. So the first year is pretty simple. You're bringing over the adjustment based on the acquisition date value. If you think about that, if you think about two things, number one, in the first year, you're just bringing over the value based on the acquisition date, again, plus or minus. And also, if you think about the fact that the A entry winds up in the consolidated columns becoming either a debit or a credit to the investment account, the offset in the A entry plus or minus debit or credit is to the investment account. That's what helps get the investment account to zero in the consolidated balance sheet. Again, remember on the consolidated balance sheet where we go from the parent's investment account, the rule is that that number, when you get over here to the consolidated, that's got to go to zero. So the A entry is part and parcel of bringing that number to zero over here. That means that in the second year, the third year, and so forth, as these assets and liabilities are either depreciated or amortized for the difference between the fair value and the book value from the initial acquisition date, as they are done, as that is done, this investment account changes based on those changes. So the delta each year of the investment account is going to be based on the depreciation, the amortization of either assets, tangible, intangible, or liabilities. Every year that's going to be the adjustment to the investment account under the equity method. Think about it. Remember, the equity method takes into account these depreciations and amortizations every year against the income from the subsidiary on the parent's books, but the offset is to the investment account. Let's remember this entry. Let's go back one more time and remember the entry. The entry is, let's say it's depreciation that is too much on the books of the subsidiary because the asset was lower at the acquisition date, the fair value was lower. So we're trying to lower the depreciation so there'll be a credit to, well, it won't be a credit to depreciation on the equity investment, the equity method. On the equity method, the parent's books, that's what we're looking at now, they'll reduce the equity income by making a debit. I'm sorry, I'm doing it wrong. Because I said it this way. I said that the depreciation should be lower. So that means the book value of the subsidiary's asset was higher than the acquisition date, so we should be depreciating a lesser amount than the book value amount on the subsidiary's books. This is all Chapter 1, by the way. We did it again in Chapter 2, so this is sort of review. I know it sounds crazy when you say it out loud, but let's just say that the book value of the subsidiary was 100, but the fair value was 80. This is outside of the parents' numbers. So we would say if it was a 5-year life, that $20 difference, the subsidiary is depreciating too much by $20 based on the fair value. So over 5 years, that's $4 a year. And so the parent on the equity method would make the following entry. They would, and I'm just going to ask you to recall this and go back to Chapter 1 if you're not sure. They would debit the investment account for the $4 and they'd credit the equity income. So they'd actually increase the equity income, which is right, because under the equity method, what the parent's saying is that, hey, subsidiary, you're depreciating too much compared to what we think the depreciation should be based on when we bought the asset inside of the consolidation, inside of this purchase. So we're reducing depreciation. By reducing depreciation, the equity income should go up, and that's a credit, and the offset is that the investment account goes down. So my point is that every year this investment account is getting adjusted under the equity method on the parent's books by these differences, whether they're up, down, or sideways. The investment account keeps getting adjusted for the prior year's depreciation. So if this is year 1, year 2, year 3, 4, etc., that investment account over here on the parent's books under the investment under the equity method, the investment account under the equity method on the parent's books is constantly being adjusted for these differences. So if the differences should be bringing the investment account down, let's say, because of the way the adjustments are working, so over time the depreciation will cause the investment account to go down. It could go the other way as well, but whatever it is, whatever the plus or minus is the investment account each year is getting adjusted for the prior year's amortization depreciation for the prior years. So what does that mean? When you come to the A entry then, in year, let's say year 5, when you come to year 5, the A entry is going to be the following. It's going to be bringing over the asset values as they are adjusted after 4 years of amortization depreciation adjustments. Let me say that again. The A entry in year 5 is going to be taking into account years 1, 2, 3, or 4 of any depreciation or amortization that occurred because using the equity method, the parent adjusted the investment account based on each year's amortization and depreciation adjustments. So when you look at the A entry in year 5 or any year, the prior years, the investment account has already taken into account the depreciation and amortization. So your new values for the A entry, your values now for the assets and liabilities, have to be adjusted compared to what you did on acquisition date to take into account all these prior amortizations and depreciations in these individual assets. So one example to try to take what is very difficult to explain home to roost. Let's say at the date of acquisition, we only had one asset with a difference, and the book value of that asset, let's do again the easy numbers, was 100, but the fair value was, let's make it again easy, was 200, and it was a 5-year life. That means under the equity method, for this delta of $100, each year we're going to depreciate $20. So this is a depreciation where we're going to just add depreciation. We're not taking away because it was the fair value is greater than the book value. So each year we're going to be under the equity method, and you remember this under the equity method. Each year we're going to be adding depreciation under the equity method, and if we were doing the consolidation, we would just do it in the consolidation worksheet. How would it look in the consolidation worksheet? Well, for year 1, it would look like this. We would have the asset, and we'd have depreciation expense. I'm not doing it in the right order of a trial balance, but you get the idea. And so the asset would come over at, the adjustment would be, if this is the elimination entry, as they call it, so it's our adjustment to beef up the book value of the subsidiary by the $100 difference, and then we would simply put an extra $20 of depreciation to get to the consolidated. This is what the worksheet would look like. All part of the A entry would help get rid of, well, not all part of it. This is the part of the A entry. That's my point. And so in year one, it's the complete difference of the $100 here. That's year one, the complete difference of the $100. Now in year two, what happens is with the A entry, in year two, we come to the asset, come to the asset, and we got the depreciation. And we know that in our elimination entry column, we're going to add $20 depreciation, because that's going to be every year until it's fully depreciated. And that way in the consolidation, we'll have this extra $20 depreciation added in. But when it comes to the asset itself, now if we want to bring over the asset into the consolidated balance sheet, we can't bring over the $100 in our A entry, because last year in year two, this is year two, last year in year one, I mean, we reduced this by the $20 depreciation. This came down by $20 in depreciation in year one. So in year one, at the end of year one, it was really only $80 after the depreciation. So that's why in year two, what's going to happen is we're not going to, our A entry won't be like it was in year one for the 100. It'll be for the net differential, the $80. So our A entry will now take into account the prior year's depreciation, the prior year's amortization, and assets and liabilities, as the case may be, and that will make the A entry work out perfectly in the debit credit to the investment account. You shall see when you try it. And so it should come over to the consolidated at the 80 instead of the $100. Now all that was said, assuming you're doing the asset net of accumulated depreciation. The same thing is true if you're doing the asset at historical cost. Everything I said would be true except the adjustment would be to the accumulated depreciation. So everything I said so far, and you'll need to work this out in your mind because it's just simple intermediate accounting, is true if you're doing the asset net of accumulated depreciation. If you're bringing the asset over at historical cost and it's the accumulated depreciation that you're also bringing over each year, then the accumulated depreciation has to be adjusted for the prior amortization and depreciation that took place. Go see in your textbook how that works out. Either way, it's the same thing. The entry becomes the same, and that's why the A entry changes from year to year. Bingo, zappo, doodah. And that's that.